You get your paycheck. You glance at the number and think, okay, not bad. Then you look closer. Federal tax, state tax, Social Security, Medicare, health insurance, 401k. And suddenly, that $5,000 monthly paycheck turns into $3,400. And somehow, by the end of the month, it's gone. No yacht, no mansion, no crazy lifestyle. Just rent, groceries, gas, and a mild sense of financial anxiety. If you've ever looked at your bank account and thought, wait, I make decent money, why do I still feel stuck? That's literally the middle-class experience. And here's the thing, it's not just about how much you make, it's about the invisible tax traps quietly draining your wealth without you even realizing it. My name is Zach, and I spend way too much time thinking about how the tax system quietly shapes the financial future of the middle class. If you're someone who works hard, earns a decent income, but still feels like wealth keeps slipping through your fingers, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Because today, we're talking about something most people never see. Not tax rates, not loopholes for billionaires, but the 4 invisible tax traps that keep the middle class running in place. And look, some of these are going to sound harmless at first. That's what makes them dangerous. Trap number 1, the bracket illusion. Let's start with the most misunderstood concept in personal finance, tax brackets. Now you might be thinking, Zach, I know how tax brackets work. Are you sure? Because here's what most people think happens. If I move into the 22% tax bracket, all my income gets taxed at 22%. That's not how it works. The US has a progressive tax system. Only the income within each bracket is taxed at that rate. For example, let's say you're single and make $60,000. In 2024, roughly 10% on the first chunk, 12% on the next, 22% on the amount above about $47,000. But here's where it gets interesting. Even though you're in the 22% bracket, your effective tax rate might only be around 13 to 15%. So what's the trap? The trap is psychological, because millions of people turn down overtime, raises, or promotions because they think, I'll just be put in a higher tax bracket. That belief costs real money. Let's run the math. If a promotion gives you $5,000 raise and pushes $5,000 into the 22% bracket, you don't lose 22% of your entire income. You pay 22% on that $5,000. That's $1,100 in taxes. You still keep $3,900. Turning that down is like saying, no thanks, I don't want $3,900. That's not financial strategy, that's fear disguised as caution. But here's the deeper issue. The bracket illusion creates a mindset where people focus on avoiding taxes instead of maximizing income. And wealth is built by expanding income, not shrinking opportunity. Trap number 2, lifestyle inflation plus tax creep. Okay, you get the raise. You didn't fall for the bracket myth. Great. But now something subtle happens. Your lifestyle expands to match your income. This is called lifestyle inflation. And here's what most people don't realize. The IRS loves lifestyle inflation. Let's break it down. You get promoted from $60,000 to $80,000. After taxes, that might be about $12,000 to $14,000 more per year in your pocket. What happens next? Better apartment, new car payment, more dinners out, upgraded subscriptions, slightly nicer vacations. None of this feels extreme, but here's the math. Let's say your new car payment is $450 a month. That's $5,400 per year. To afford that after taxes, you might need to earn $7,000 to $8,000 pre-tax. You're now working more hours to maintain a liability. And this is where it gets really interesting. Lifestyle upgrades are paid with after-tax dollars. Investments grow in pre-tax or tax-advantaged environments. There's a massive difference. If instead of that $450 car payment, you invested $450 a month in an index fund earning 8% annually, in 20 years, that's over $260,000. That's not a small decision. That's the difference between optional work and mandatory work in your 50s. The middle class often upgrades lifestyle before upgrading assets. The wealthy upgrade assets first and let lifestyle follow later. Trap number 3, the W-2 dependency trap. This one's uncomfortable. If all your income comes from a W-2 job, you are paying the highest possible tax treatment available to regular people. W-2 income is taxed federal, state, Social Security 6.2%, Medicare 1.45%. That's 7.65% in payroll taxes alone. If you make $80,000, 7.65% equals $6,120 before federal income tax even kicks in. And here's what most people don't realize. Payroll taxes apply from $1. There are no lower brackets for them. And if you're self-employed, you pay both sides 15.3%. Now, I'm not saying quit your job tomorrow, but here's the real trap. When your entire income is W-2, you have limited deduction flexibility. Business owners can deduct business expenses, equipment, part of their home, travel, legitimately structured, health insurance premiums. Employees? Standard deduction, maybe mortgage interest, maybe some credits. That's it. This creates a system where labor income is taxed heavily. Asset income, capital gains, qualified dividends is taxed lower. For many middle-class earners, long-term capital gains are taxed at 0% or 15%. Compare that to 22% ordinary income rates. That's an enormous gap. And psychologically, it keeps people stuck trading time for taxed dollars instead of building assets that generate preferentially taxed income. Now, you might be thinking, so I need to start a business? Not necessarily, but you need to understand that tax systems reward ownership, not labor alone. Even small steps like building side income, investing in index funds, or purchasing rental property begin shifting you from pure W-2 taxation toward more efficient structures. Trap number 4, the refund illusion. This one makes people mad, and I get it. You get a $3,000 tax refund. It feels amazing, like winning a mini lottery. You think, nice, the government gave me money back. No, they returned your own money, interest-free. Let's do the math. If you get a $3,000 refund every year, that means roughly $250 was over-withheld. Imagine investing $250 a month instead at 8%. After 20 years, that's about $147,000. Instead, you gave the government a free loan. Now look, I understand the psychology. Forced savings feels safe. Behaviorally, some people need that structure. But here's the thing. If you rely on tax refunds to save, you don't have a cash flow system. And without cash flow control, wealth is almost impossible. The middle class often celebrates refunds. The wealthy optimize withholding. That difference compounds. The psychology behind all 4 traps. Let's zoom out. These aren't just math problems, they're psychological traps. Bracket fear, avoiding growth. Lifestyle inflation, immediate gratification. W-2 dependency, comfort and predictability. Refund illusion, emotional reward cycles. The human brain prefers certainty, short-term rewards, and avoiding perceived loss. The tax system quietly exploits those tendencies. And look, this isn't some conspiracy. It's just how incentives work. Most people don't optimize because optimization requires delayed gratification, and delayed gratification is uncomfortable. Actionable steps you can take this year. Okay, let's get practical. Here's how you escape these traps. Step 1. Calculate your effective tax rate. Stop guessing. Take your total tax paid last year and divide by total income. If you made $70,000 and paid $9,800 in federal tax, $9,800 divided by $70,000 equals 14%. Now you're thinking in reality, not headlines. Step 2. Automate investment before lifestyle. When you get a raise, increase investments first. If you get a $500 a month raise, invest $350. Upgrade lifestyle with $150. This flips the script. Step 3. Add asset-based income. Start small. Invest in broad market index funds. Explore dividend-paying ETFs. Learn about real estate. Consider a side skill that becomes a business. You don't need to become a CEO. You just need to move from 100% labor income to 90%, then 80%, then 70%. Step 4. Adjust withholding strategically. Use the IRS withholding estimator. Aim for a small refund or close to zero. Then automate the difference into brokerage accounts, Roth IRA, high-yield savings. Give yourself the interest. The bigger picture. Here's what most people don't realize.